criminal activity in crypto rarely happens at random. Most illicit behavior follows recognizable patterns. These patterns are what we call AML typologies. A typology is not a single transaction. It is a repeated behavior observed over time. One transaction may look harmless, but when you zoom out, patterns begin to emerge. Typologies help investigators move from raw data to meaningful narratives. They explain how criminals place funds into crypto, how they obscure them through layering, and how they eventually integrate value back into the economy. This module focuses on those patterns. Not on tools. Not on individual alerts. But on how financial crime actually unfolds on-chain. Understanding typologies is what turns blockchain data into risk-based decisions. The first stage of money laundering is placement. In crypto, placement means converting illicit value into crypto assets. This does not always involve banks. Criminals often use peer-to-peer platforms or informal brokers. In some cases, funds never touch a regulated exchange. The goal is simple: get value on-chain while avoiding scrutiny. At this stage, transactions may look ordinary. Once on-chain, layering becomes faster and harder to trace. Weak placement controls create risk across the entire ecosystem. Placement in crypto often begins long before complex blockchain activity appears. One of the most common entry points is the fiat on-ramp, where cash is first converted into crypto. Peer-to-peer platforms play a central role, allowing users to buy crypto directly from other individuals. A typical placement typology is smuffing, where funds are divided into many small transactions below monitoring thresholds. These transactions are often spread across multiple accounts, devices, or payment methods. Over time, the crypto is consolidated into aggregator wallets, the first control point in the chain. This activity is frequently routed through jurisdictions with weak KYC requirements or inconsistent enforcement. Individually, these transactions look normal. Together, they form a clear placement pattern. In crypto investigations, placement is quiet, repetitive, and designed to look normal. Not all illicit crypto enters the ecosystem through fiat. Some placement methods are crypto-native. They are designed to create the appearance of clean or newly generated assets. Mining is one example. Illicit funds may be used to finance mining operations, turning dirty money into newly issued crypto with no transaction history. Airdrops are another entry point. Criminals exploit this by farming them across thousands of controlled addresses. Early-stage acquisition is also common. Funds from scams or hacks often start the laundering chain. Because these assets appear early in their life cycle, they are often perceived as lower risk. But freshness does not equal legitimacy. In crypto investigations, the source of control matters more. The age of the coins is secondary. New crypto can still be criminal crypto. Once illicit value enters crypto, the next stage is layering. Layering is about breaking the link between the funds and their criminal origin. In crypto, layering is fast. Funds can move across dozens of wallets in minutes. It is also cheap. Transactions cost cents, not fees charged by banks or intermediaries. And it is global by default. Criminals use multiple blockchains, cross-chain bridges, and decentralized platforms. The objective is not to hide a single transaction, but to overwhelm analysis with volume and complexity. At this stage, speed becomes a weapon. And scale becomes the strategy. For investigators, layering is where patterns matter more than transactions. In crypto investigations, not all privacy techniques are treated the same. Mixers and tumblers are tools designed to break the visible link between sender and receiver. Technically, they combine multiple transactions and redistribute funds, making tracing more difficult. But in AML analysis, the question is not whether obfuscation exists. The question is why. Why was obfuscation necessary at that moment in the transaction flow? When mixers are used immediately after illicit inflows, it is a strong indicator of intent to conceal. This is why mixers frequently appear in ransomware, sanctions evasion, and dark net market cases. Using a mixer is not illegal by itself. Context, timing, and surrounding behavior matter. In investigations, obfuscation plus suspicious context is not privacy. It is evidence. Another common laundering technique in crypto is chain hopping. Chain hopping means moving funds across different blockchains to disrupt transaction tracing. This is often done through exchanges, bridges, or atomic swaps. Each blockchain has different data structures, analytics models, and visibility limits. Every hop increases investigative complexity, time, and uncertainty. When multiple hops occur without an economic reason, investigators treat this as a red flag. Chain hopping appears frequently in ransomware cases and sanctions evasion. Moving across chains is not illegal by itself. Legitimate users do it every day. What matters is context, timing, sequence, and proximity to high-risk activity. In crypto AML, unnecessary complexity often signals intent to hide, not innovation. Cross-chain bridges are a core part of the crypto ecosystem. But they also introduce serious AML blind spots. Bridges allow users to move value from one blockchain to another without selling the asset. Typically, assets are locked on one chain and reissued or wrapped on another. This process often breaks the on-chain transaction trail investigators rely on. Once assets cross the bridge, attribution becomes weaker and risk signals may not transfer cleanly. Bridges are frequently used in hacks, sanctions evasion, and large-scale laundering cases. In crypto AML, infrastructure becomes a risk when it obscures accountability, not when it enables innovation. Decentralized finance introduced a new way to move value, without traditional intermediaries. DeFi protocols allow users to trade, lend, and earn yield using smart contracts. These protocols are open, automated, and often permissionless. From an AML perspective, DeFi creates powerful layering opportunities. Illicit funds can be swapped, pooled, staked, and withdrawn across multiple protocols in minutes. Each interaction fragments the transaction trail and weakens attribution. Rapid DeFi activity with no economic rationale is a major red flag. Legitimate users use DeFi daily. Volume alone is not suspicious. Investigators look at sequencing, timing, and intent, not just protocol usage. In DeFi, smart contracts replace intermediaries, but they don't remove accountability. Not all laundering relies on complexity. Sometimes, fragmentation is enough. A peel chain is a technique where value is slowly peeled off across many transactions. One wallet sends a small portion forward, keeps the rest, and repeats the process. Criminals use hundreds of microtransactions to create noise and overwhelm monitoring systems. Individually, these transfers look harmless. Together, they obscure the original source of funds. The risk is not size, it's structure and repetition. Analysts must focus on flow continuity to identify these fragmentation patterns. Laundering doesn't end on-chain. It ends when value becomes usable again. Integration is the stage where illicit crypto is converted into real economic value. This is where financial crime becomes visible to the real world. Common paths include exchanges, OTC desks, and peer-to-peer sales. Criminals also integrate value through assets like real estate, luxury goods, or NFTs. Funds are often withdrawn gradually to avoid thresholds and detection. Rapid off-ramping and inconsistent customer profiles raise serious red flags. Investigators trace continuity from initial entry, through obfuscation, to the final exit. This is why regulators focus so heavily on on-ramps and off-ramps. Crime becomes real when crypto becomes spendable. Always follow the exit. In crypto investigations, risk does not end on-chain. It concentrates at the exit. Off-ramps are where crypto is converted back into fiat or real-world value. And this is often where laundering becomes visible. This includes centralized exchanges, OTC desks, and peer-to-peer cash-out services. OTC brokers are frequently used to move large volumes with limited transparency. Nested services add another layer, allowing transactions to flow through intermediaries that rely on someone else's controls. Peer-to-peer cash-outs are even harder. Funds move directly between individuals, often outside regulated environments. These channels are attractive because monitoring is weaker, and scrutiny is inconsistent. From an AML perspective, this is a critical choke point. The key lesson is simple: on-chain analysis explains movement. Off-ramps reveal intent. In crypto laundering, integration is about making value look legitimate. One common method is asset acquisition. NFTs are one example. They allow value to be transferred under the label of art or collectibles. This is often achieved through wash trading between related wallets to inflate value. Real estate is another. Crypto funds are converted to acquire property through intermediaries. This creates the appearance of a lawful, long-term investment. Luxury goods like watches, cars, and jewelry can absorb large amounts of value with minimal scrutiny. These items retain value while avoiding the strict oversight of traditional banking. The risk is not the asset itself. It is the lack of economic rationale and circular ownership patterns. From an AML perspective, these purchases complete the laundering cycle. They transform illicit flows into assets that look clean and socially acceptable. When crypto becomes an asset, risk does not disappear. It just changes form. Illicit funds do not always exit crypto through banks or exchanges. In many cases, they pass through gambling and gaming platforms first. These platforms offer 3 advantages for criminals. First, high transaction velocity. Second, behavioral normalization. And third, weak or inconsistent monitoring. High transaction velocity creates noise that obscures the original source. Second, behavioral normalization. Gambling and gaming activity looks legitimate on-chain. In gambling, rapid betting cycles create plausible deniability. Many platforms operate across jurisdictions with limited AML oversight. The result is integration without a clear laundering signature. This is a high-risk integration point. High speed hides risk. Velocity replaces complexity. Some crypto typologies are not about laundering profits, they are about enabling harm. Ransomware, terrorism financing, and sanctions evasion require a different investigative lens. Ransomware payments move fast. Victims pay, funds are mixed, bridged, and cashed out quickly. Speed and urgency are the key red flags. Terrorist financing often involves small amounts, repeated donations, and ideological messaging. Volumes are low, but intent is extreme. Traditional thresholds don't work here. In these cases, intent matters more than volume. Sanctions and high-risk typologies rely on detecting access and ideology, not just large transfers. Stablecoins are not just a payment tool. They have become the primary infrastructure for illicit value movement in crypto. Unlike volatile assets, stablecoins offer price stability, deep liquidity, and global acceptance. This makes them ideal for laundering. Criminals use them to move large amounts quickly, and park value without exposure to market swings. They also access offshore liquidity that resembles shadow banking, outside the traditional financial system. In many regions, stablecoins function as de facto dollar accounts for those outside the banking system. Velocity is high. Slippage is low. This is why most illicit volume flows through stablecoins, not privacy coins. Stablecoins are not anonymous. But their scale, speed, and liquidity make enforcement harder. This is why regulators focus on stablecoin issuers, on-ramps, and off-ramps, not just wallets. The key lesson is simple: when money becomes infrastructure, risk scales with it. Layer 2 solutions were built to scale crypto. Lower fees. Faster transactions. Higher throughput. But they also change how investigations work. Many transactions happen off the main blockchain. On Layer 2 networks and the Lightning Network, many transactions happen off-chain. Only the opening and closing balances are fully visible. This reduces transparency for investigators. Transaction paths become compressed. Timing signals disappear. Behavioral patterns are harder to reconstruct. It creates blind spots for investigators. Criminals exploit these environments to move value quickly and fragment flows. They reduce traceability before returning to layer 1. Regulation struggles to keep pace. Monitoring tools were designed for on-chain activity, not high-speed settlement layers. When scalability increases faster than oversight, risk accumulates silently. Typologies are essential in crypto AML. They help investigators recognize common behaviors, flag risks, and prioritize alerts. But typologies are not proof. No criminal activity follows a perfect template. The same pattern can appear in legitimate activity. And real crime often blends multiple typologies at once. False positives are inevitable. Shared infrastructure, market volatility, and user behavior can mimic illicit signals. Real cases often combine multiple typologies at once. This is why investigations require judgment, not checklists. Analysts must evaluate who is involved, why the behavior occurred, and whether the activity makes economic sense. Typologies guide attention. They do not replace thinking. Typologies are not the end of an investigation. They are the starting point. Each typology is a signal, not a conclusion. Real risk decisions are made by combining indicators. Transaction behavior, counterparty exposure, jurisdictional risk, and user context. No single pattern proves illicit activity. But multiple weak signals, when combined, can form a strong risk narrative. This is why crypto AML is cumulative. Investigators do not ask, does this match a typology? They ask, does this activity make sense, economically, operationally, and behaviorally? Risk decisions are about probability, not certainty. And effective compliance is about acting before harm occurs, not after it is proven. Typologies inform judgment. Judgment drives decisions. Judgment is the control.